Harish Krishnan is with us, Co-Chief Investment Officer, Head Equity at Aditya Birla Sun Life AMC. Harish, good to have you with us here. Thank you very much for your time. You know, Sanjeev Prasad of Kotak Institutional Equities was pointing out, and of course he's long been skeptical of some of the valuations and where we've been trading. But he mentioned something interesting. He said, well, the last 2 or 3 days of the sell-off that we've seen, it remains to be seen whether it will test the conviction of non-institutional investors, as he called it. Retail mostly is what he was referring to. So let me ask you, over the last 2 days, I mean, you'd have the data. Have the flows remained as robust and strong to kick off this conversation, Harish?
Good morning, Prashant. So I think, 2 days is too short a time frame to change the habit, and a habit that has been inculcated since COVID lows. So you've had a 4-year kind of a move wherein corrections have been far and few, and they've been vociferously bought. And if at all, I guess the takeaway is that even this correction, led by global forces and macro, has been quickly bought in, not only in India, but even across the world. So I guess the habit-seeking change, possibly that you're referring to, at least given the last 3 months, wherein you've had reasonably fundamental setbacks, be that of the elections, be that of the budget, increasing capital gains tax, be that of even poorer earnings print that is starting to come through, and then the macro headwinds or the macro change led by the Japanese yen, unwind of carry trade. I guess all of these dips have been vociferously bought. So if at all, it is further reinforcing that habit rather than taking away from the habit that they have learned over the course of the last 4 years.
Harish, I remember when you were, and correct me if I'm wrong here, but just going on a sort of limb here, but you were with us on that on an editors roundtable program, and you did mention that the biggest risk for the market, as you see it, I think you said it was the yuan, and what that currency does. It's been the yen, which is it's the currency still, or it's the yen, not the yuan. I mean, just wanted to update to your views, Harish.
Prashant, it's nice of you to remember. Yes, I did mention both the yen and the yuan, but clearly the bigger, given the fact that it's been a peg all throughout, I would still think that the yuan has got possibly a far bigger wrecking ball, if I may, should something happen out there. Clearly, from a perspective, we are seeing fault lines emerge, wherein the largest economy, US, is slowing down significantly. You are seeing divergences in Japan, and this is where I guess there is a fault line emerging, which is where one is seeing what one has seen over the course of the last 2 days. Having said that, I was just looking at data before coming onto the show. We've actually, when we look at positioning, and this is data that various bankers kind of give us, it does appear that a lot of the unwind is behind us from a data point of view, from a positioning point of view. Of course, in that context, today's monetary policy briefing by the Bank of Japan is still crucial from an incremental positioning point of view. But I would say that, the big delta change that came through over the course of the last week seems to be a lot more settled when I look at data as far as positioning on the currency is concerned.
Harish, hi, morning. I don't know if you could listen into the conversation just before you. There was Chris Wood speaking to our colleagues in Asia, and he was making that point, right? The surging domestic liquidity, mutual fund flows, and we're getting the numbers again on Friday. I'm bracing myself. Last month's number was 41,000 crores coming in, right? So let's see what we get this time. But for instance, that's one view. That's why he's turning tactically cautious. This wall of money is just, making the market absolutely super resilient, bulletproof. Now, is that something that we can take heart from and just keep buying, or should that be concerning even domestic investors? How do you approach this market?
I think it is definitely concerning from a domestic investor base, because ideally we want to buy companies which are anchored on the fundamental side, because as we all know, markets are slave of earnings. So while we can keep talking and analyzing about liquidity and see where the marginal buyer is coming from, the reality is that sentiment, liquidity, all of them can potentially change a lot more faster than what earnings and profitability and book values of various companies. And therefore, we place a lot more focus on fundamentals than on liquidity. Having said that, I still think that, possibly, even as we keep tracking the mutual fund data points, I think the big surprise from a pre-COVID to a post-COVID is not so much the flows that have come in through the mutual fund or the institutional platform, but clearly what has happened on the retail and HNI. And that really has been a big surprise, because if you look at the 10-year data prior to COVID, retail and HNI were net sellers of Indian equities, and they have turned into massive buyers, and they've continued to pour in with significant strength. So I think the real key difference or delta change is in terms of what is happening as far as the HNI circle or the HNI retail circle is doing in terms of setting up prices. And while we have some theories, we do think that liquidity cannot go on forever, but it does appear that for now, given whatever they have seen and encountered, liquidity is still very, very strong and buoyant.
Okay. So if that's going to continue to be the case, I go back to the question, what should one be doing in this market? Do you expect any leadership changes, for instance? The last 18 months, it's been capital goods, capex, the manufacturing side of things. Does it make sense putting in more incremental money in FMCG? Again, I'm just saying, if a retail investor wants to get a little tactical now, what should he or she be doing?
Right. So I think, we are cognizant of the fact that India's macro story looks extremely good. Yes, valuations have run up a bit ahead of themselves. More importantly, when we look at the data and we look at, say, pre-COVID till now, and we're talking about now close to about 3.5, 4 years, it's a long period of time. If I look at large, mid, small, and micro cap, first coming to the market cap story, and then I'll come to the sectoral question that you asked me. So from a market cap perspective, if I were to look at large cap, the top 100 companies, the entire delta increase in their market cap can be more than explained by the earnings that have come through. In a way, valuations have actually compressed by a tad bit. If I look at the same data for mid caps, close to about 67% of the market cap increase is explained by earnings, and about 1/3 is explained by valuation expansion. If I go into small cap, it is 50-50, and if I go to micro cap, it is about 1/3 explained by earnings and 2/3 explained by valuation. So therefore, we do think that risk has got disproportionately rewarded, and it does make sense to tone down some element of risk in our portfolio. So if you are big time into small cap, we suggest to move into mid caps. If you're into mid caps, move down to large and mid caps, etc. So that is as far as what we think from a market cap perspective. From a sectoral perspective, we do think that there are trends changing in terms of some big sectors which have led the recovery so far. Calling out two specific candidates out there, I would say one is pharma, which has been a silent performer over the course of the last 2 odd years. But I think that there is a far bigger potential that is emerging as far as pharma is concerned in terms of the ability to outperform. Do note that, pharma's peak performance peaked out in 2015. So we are talking of a long cycle of consolidation which is starting to emerge out, with earnings proving to be beating for most companies. Of course, pharma is a very heterogeneous sector, and therefore one needs to be a lot more bottom up out here. But I would say that that sector continues to potentially lead. Even in the last 3 months, it is kind of led from the front. The second space which is starting to look interesting, I would say, is consumer durables. This has again been a space from 2019 where it has kind of underperformed. Over the course of the last 6 months, yes, the summer has been very good, and therefore there has been an uptick. But even otherwise, I think the competitiveness and the profitability metrics of this sector is, I think, changed quite dramatically. The third, I would say, which is starting to emerge, possibly still some time away, I would say, is cement. Yes, the near term doesn't look very encouraging from a pricing point of view. There is a reasonable amount of consolidation which is happening. But in our mind, cement is a proxy play of energy because at every stage of manufacturing and freight, it is a very energy intensive kind of a commodity. And we do think that energy prices have kind of cooled off from that $70 to $90 band, and in case President Trump does make it, we do think that there is a potential that crude can settle even lower. So I would say these are the three packs that look interesting from a sectoral leadership point of view, from the next 18 to 24-month point of view.
Those are some really interesting thoughts. Never thought of it that way. Cement being a proxy play to energy. So pharma, cement and consumer durables, three sectors that perhaps investors can start looking at as they look at tweaking their portfolios. Thank you very much, Harish, for joining in. Great conversation and good perspective. Appreciate you being with us. You have a good rest of the day.